The ride-sharing industry has exploded in recent years, changing how we commute and travel. Uber and Lyft, the two biggest players, have become household names. Their stocks are closely watched by investors seeking to capitalize on this transformative industry. But which stock is the better buy? Let's dive into the Uber versus Lyft showdown. Uber's greatest strength lies in its global reach. It operates in over 90 countries, giving it a massive market advantage. Uber is also diversifying its revenue streams beyond ride-hailing. Uber Eats, its food delivery platform, has experienced explosive growth. This diversification makes Uber less reliant on its core ride-hailing business and potentially more resilient to economic downturns. Despite its size and reach, Uber has struggled with profitability. The company has yet to turn a consistent profit, raising concerns about its long-term sustainability. Uber also faces significant regulatory hurdles worldwide. Governments are grappling with how to regulate the ride-sharing industry, and stricter regulations could impact Uber's operations and profitability. Lyft's primary focus on the North American market is a double-edged sword. While it limits its global reach, it allows Lyft to concentrate its resources and tailor its services to a specific market. Lyft has also demonstrated better cost control than Uber. Its smaller scale and more focused approach have helped it achieve profitability, albeit inconsistently. Section 5. Lyft's weaknesses: limited scope and dependence on ride-hailing. Lyft's biggest weakness is its limited geographical scope compared to Uber. Its focus on North America makes it more susceptible to regional economic downturns. Lyft is also heavily reliant on its core ride-hailing business. While it has experimented with other services like bike and scooter rentals, it lacks the diversification of Uber's portfolio. Section 6. Market trends and future prospects. The road ahead. As we look into the future, the ride-sharing industry is poised for significant transformation and growth. The ride-sharing market is expected to continue growing in the coming years. Factors like urbanization, rising fuel prices, and the increasing need for efficient transportation solutions are driving this growth. The increasing adoption of smartphones and mobile technology is also a key driver. Both Uber and Lyft are well positioned to benefit from this trend, leveraging their established platforms and extensive user bases. However, the competitive landscape is evolving. The rise of autonomous driving technology poses both a threat and an opportunity for these companies. Autonomous vehicles could potentially reduce operational costs and improve efficiency, but they also introduce new challenges and competition. Both Uber and Lyft must navigate these changes carefully to maintain their market positions and capitalize on new opportunities in the evolving transportation ecosystem. Section 7. Uber versus Lyft. In this section, we will delve into a detailed comparison of the key financial metrics of these two ride-sharing giants. A head-to-head comparison of key metrics is essential to understand the financial health and market position of both companies. To make an informed investment decision, investors need to look beyond the surface and analyze the underlying numbers. It's crucial to compare Uber and Lyft head-to-head on key metrics such as stock price, market capitalization, and price-to-earnings ratio. As of today, July 1st, 2024, we have the latest data to help us in this comparison. Uber trades at insert Uber's current stock price, dollars per share, reflecting its current market valuation and investor sentiment. While Lyft is trading at insert Lyft's current stock price, dollars per share, showing a different market perception and valuation. Uber boasts a significantly larger market capitalization of insert Uber's market cap, dollars compared to Lyft's, insert Lyft's market cap, dollars. This indicates Uber's dominant position in the market. However, Lyft has a slight edge in terms of price-to-earnings ratio, which is a critical metric for evaluating a company's profitability relative to its stock price, indicating potentially better value for investors. This means that despite its smaller size, Lyft might offer more attractive returns based on its current earnings. Investors should consider these metrics carefully, when deciding where to allocate their funds. Section 8. The verdict. Which ride-sharing stock wins? In this section, we will delve deeper into the factors that could influence your decision when choosing between Uber and Lyft stocks. So, which stock is the better investment, Uber or Lyft? It's a tough call. Both companies have their unique strengths and weaknesses, and the right choice depends on various factors, including market conditions, company performance, and your personal investment strategy. Uber's global scale, diversification, and potential in autonomous driving make it attractive. The company operates in numerous countries, offering a wide range of services beyond ride-hailing, such as food delivery and freight. This diversification can provide a buffer against market fluctuations in any one sector. However, its profitability concerns and regulatory hurdles cannot be ignored. Despite its vast reach, Uber has struggled to turn a consistent profit, and it faces significant regulatory challenges in various markets, which could impact its long-term growth. Lyft's North American focus, cost control, and recent profitability are enticing. The company has managed to streamline its operations and achieve profitability in recent quarters, which is a positive sign for investors looking for stability. But its limited scope and dependence on ride-hailing pose risks. Unlike Uber, Lyft is heavily reliant on the North American market and does not have the same level of diversification. This makes it more vulnerable to regional economic downturns and competitive pressures. Ultimately, the best investment for you depends on your risk tolerance and investment goals. Are you looking for a high-risk, high-reward opportunity, or do you prefer a more conservative investment with steady returns? If you're comfortable with higher risk and believe in Uber's long-term potential, it might be the better choice. Uber's investments in autonomous driving technology and its global presence could pay off significantly in the future. But this comes with higher volatility and uncertainty. If you prefer a more conservative approach and value profitability, Lyft could be a safer bet. With its recent profitability and focus on cost control, Lyft offers a more stable investment, though it may not have the same explosive growth potential as Uber. Remember, investing in the stock market always carries risks. Market conditions can change rapidly, and what seems like a good investment today might not be tomorrow. And past performance is not indicative of future results. Do your research, consider your options carefully, and invest wisely. Consulting with a financial advisor can also provide valuable insights tailored to your specific financial situation and goals.